Company news aside, navigating financial markets has been challenging lately due to elevated interest rates, economic uncertainty and escalating geopolitical tensions. Business Day TV's Bronwyn Seaborn sat down with Discovery Invest CEO Kenny Rabson to discuss these risks and their impact on investors when constructing their portfolios.
I think it's really just the abundance of choice that clients have and the complexity behind all of those choices. Markets are complicated. They're not just kind of affected by what companies do, there's geopolitical influence, etc., which all plays an important part. So for an advisor to be able to really process that amount of information, we know there are in excess of 140,000 unit trusts globally. And if you think that's equity funds and fixed interest funds and alternative investments and cryptocurrencies and all property investment, how do you actually construct a portfolio for a client with all that information? What's really increased it so much is this thing that you can now take with Reg 28, 45% of the money can be offshore. So now you have to know how to deal with that global world. And it's just so difficult without the technology behind it.
And so the role of financial advisors really becoming crucial right now.
The role is crucial and incredibly complex from so many aspects, because they need to make sure they're getting clients just to invest for their retirement and their long-term planning. That's hard enough on its own. They then need to make sure that they're putting clients in portfolios that perform and give the right type of return in the future. And then importantly, they need to know those assets will last for a client's retirement. I mean, how often we see people build up a retirement fund and it just doesn't last through retirement. And people, we know they're living longer. I mean, that's some of the data we have in Discovery Health, Vitality. We know longevity is increasing. We know medical innovation continues to increase. So longevity will just improve even more and more. How do you make sure that people have a healthy retirement? And therefore that the money they have in retirement is not being drained by out-of-pocket medical expenses, frail care costs, private nursing at home, etc. That can really deplete a person's total retirement pot.
Because that's the crux of it, right? A lot of people are saying, yes, we're living longer. Great, happy to live longer. But it's the quality of life that comes with it. Absolutely. Because generally your expenses are increasing in order to live that little bit longer that you now can.
Absolutely. So look, every individual's different, I guess, in retirement, and sick. Some sick people will be big spenders, others lower spenders, etc. But I think importantly is that it's a fear of the unknown medical expenses. Obviously, people on medical aids and all of that, and that covers a large portion of their expenses. But the out-of-pocket can easily increase, either because people have to fund private nursing and things like that, or they have to upgrade to more expensive medical plans which cover more, which obviously also depletes disposable income. Or they need to actually try and buy other products, critical illness insurance or something like that, to help fill the gap. So it's that fear of the unknown, and advisors need to kind of almost become not just financial advisors. In a way, they need to kind of migrate a little bit to being longevity coaches as well, because you have to factor that in to what a client's spending is going to be into retirement.
We talk about retirement, but there's a whole long process that comes before you actually retire. And within that process, we now have something called the Twopart system. Once that came into being, we really saw a lot of outflows, a lot of people drawing down on their funds. Are you yet convinced this was a good move, or are we still trying to grapple with what kind of impact this could have on retirements further down the line?
Look, I think with any legislation, there are pros and cons. On the one hand, it was put in place that people who really desperately needed money would be able to access retirement money. It doesn't make sense to say to someone, you've got a great retirement fund building up, but meanwhile your house fell down, right? So it creates an access route for people who need the money. On the other hand, I think what's happened is everyone is accessing that pot of money. We tend to see very little accessing of it through financial advisors. Those clients tend to go to their advisor, get advice, should we, shouldn't we, and advisors have generally kept them invested. So I think that's good. The real challenge, I guess, is what people are doing with the money they're pulling out. Are they just going and spending it? If they're spending it, on the one hand, it's damaging their retirement plan, but probably from an economy point of view, it's lifting the GDP of the country. Of course, SARS are getting a lot more tax on the back of it. GDP will probably grow. So that's the positive side of it. But at an individual client level, it may have a negative impact. It will have a negative impact on their retirement fund.
Because I think the thinking out there, and it's for a lot of people we've noticed in their 40s, making use of the two-part system, a lot of the thinking is, but I'll make up for it. Yeah. Can you make up for it?
So that's a huge problem, that people think they can make up for it, but they actually don't. Number one, they tend to not have the funds to make up, and the actual obligation becomes exponential. When you pull out something now and you try and make up in 2 or 3 years' time, you've actually got to put a lot more in to make up for what you took out plus the growth that you lost. So it's very difficult to make it up, and my gut feel is most people won't make up what they've pulled out. So I guess that's the downside of it, but legislation settles. People won't be so rash. I think we expect it up front. This thing opens 1st of September, a lot of people will just do withdrawals. I think over time, hopefully common sense will prevail, and only those who really need it will pull the money.
Can you, in your talk as well, you mentioned something quite important and something quite interesting, and that's conservatism. You notice that people are far more conservative. So we have on the one hand, people rushing to withdraw their savings and take advantage of two-part, and then you also have people who want to really just play it safe. There's this real aversion to risk. Talk us through that, this risk aversion versus conservatism, and where do you sit on that?
The truth is, I think most people, and we've seen in South Africa, have moved into income or cash funds over the last couple of years. It's irrational, because we know over the long term that equities will provide better returns than cash over the long term. And in fact, what tends to happen is they move into cash because they're conservative, but they forget to move back into the market when they need to. So we've got lots of clients, and I'm sure all platforms in South Africa have lots of clients sitting in cash today, and stock markets have had a fantastic 6 to 8 months. So I think there's huge opportunity cost by doing that. It far outweighs the extra interest they would have earned when interest rates were higher. Of course, that was some of the rationale. I think, though, that really talks to the reason or the need to have companies like Cogence. Because the truth is, you need to actually have comfort that my money is being run with a long-term objective. I don't have to worry about what happens day to day. Do I need to be a bit more conservative? Do I have to worry about stock markets crashing? That is what there's a whole team of experts doing. And if you think of a company like BlackRock, which is global, in excess of nearly 40 countries, thousands of researchers putting your portfolio together, okay, that should give people, I think, a lot of comfort that I don't have to be worried. Over the long term, I'm going to get what I need. That kind of short-term mindset. I'm a bit nervous today, what should I do? And you get a financial advisor says, look, things are a bit, I'm switching you. It's irrational, the decision making, but very often it's because the financial advisor is also doesn't want to kind of get the rap for bad performance. And that's why you need to trust professionals who do this, for a living and give consistent performance over the long term.
That was Discovery Invest CEO Kenny Rabson.